Well, welcome, Corpco Retirement Group clients, to today's educational webcast titled Changing Investment Markets and Investment Allocations. So before we get started, of course, disclosure. As I always discuss, this is educational only, so there's not any specific advice to anybody listening or viewing. If you need specific advice, please see your own CPA, CFP, advisor, etc. So let's get started. It's always smart to kind of look back what happened last year. I guess in this picture, the bear's probably, that's me in the suit trying to push the bear out of the way. It wasn't successful last year. So last year was kind of rough. You know, many of you might get your statements or opening up your retirement accounts and saying, what happened? But I think we've got to look at last year because it's a good barometer of the year we're now almost a month into, and what may bode for the future. So looking at 2022, what markets did well in 2022? You might say, wait a minute, nothing was up last year, Dave. Yeah, no, it actually was. I mean, if you think about these basic areas, you'll understand why they went up last year in terms of rate of return. Energy goes without saying, right? We all were filling up our automobiles and the price of gas was sky high. Probably more June, July was the peak last year at $5.50 or so a gallon. It's come down quite a bit, but nonetheless, any company that was in that sector, pick the big one we know, the Sunoco, the ExxonMobil, the Shell, they all obviously did very, very well. And there was also a little bit of a crisis, the Baltic area of the world, with a fight going on, if you will, between Ukraine and Russia. And those areas of the world produce a fair amount of gas needed for the Eastern Bloc areas, and also exporting. So that crisis, of course, affected the price of gas and production over in that area of the world, which does trickle down to the U.S. Utilities did well, and they usually do well in inflationary times and times of economic unrest, because they're in a sector we all need. Everyone needs Eversource. You need to turn your lights on. Everybody needs to plug in all your electrical devices, your appliances in the kitchen and so forth. So can't be without utilities. Consumer staples are, generally that area of food, clothing. You have to have it in terms of a need. So that's where the term comes from, kind of a staple. You can't really be without it, like kind of bread and water. Didn't close up last year any crazy plus, but compared to the rest of the markets, as you can see in the NASDAQ, real estate, tech sectors, consumer staples kind of flat. But interestingly, take a look, on the far right of this slide, you'll see the 2023's already started out very well through the first 3 weeks of trading. The sectors that did super well last year, energy is still up, but utilities is down a little. But conversely, for the other sectors on the bottom of the page that did poorly, they're starting to show some positive traction. So what went up last year? Let's look at what went down. A lot of sectors went down. Communication, obviously, that area, you might say, well, how could that have such an adjustment? I mean, we all needed the Zoom, we all needed the WebEx, we need the Verizon at the house or the Comcast, whatever we use. Well, the reason is I think it kind of got saturated, and they could only, that is, the Verizon of the world, the Comcast, increased their prices so much. So as a company, their profits went down. Doesn't mean they're going out of business, but that's sort of what happened in that sector in 2022. Consumer discretionary is taking a trip, buying the automobile. Maybe you put it off because interest rates went up a little. Technology just cooled off. I mean, technology's been on a ferocious tear growth-wise, probably in the 30% range. Some of these companies like Amazon, Apple, Google, Microsoft, just really had to come down to earth, and that's what happened. But again, don't count those sectors out, certainly. Real estate, be careful here. This isn't your local residential home, per se. This is more a sector, say, of the development for long-term care, or the development of a big rental apartment building, or warehouse space for Costco, Walmart, Amazon, warehouse space for cloud computing. They need storage areas. So that's the real estate area they're talking about here, sector-wise. Didn't do well last year. Again, it was big adjustment, probably a little bit of oversupply. Interest rates went up a little bit, certainly to borrow money and develop projects. However, you see this year, it's already started to climb back out. So if there's a lesson in any of these two slides, it's that, yes, 2022 was pretty rough for a lot of sectors, but be careful when you want to immediately just get out of this particular investment or particular sector because you can't take it anymore. Look at these minuses. Stay balanced, which is what we're certainly going to get to in the theme of this discussion today, and allocation. So let's keep looking at, the history, kind of crashes. Why I put this up? I think people, and myself included, kind of lose sight sometimes of the fact that crashes aren't just a one time. 2022 was a rough adjustment, almost minus 20%. But if you look at not too long ago, 3 years this March, the start of COVID, that was a precipitous fall, probably 35%. Came back, as we know. The Bitcoin next to it, again, be careful here. This isn't the FTX of last year, which, by the way, I feel is going to be the start of something positive, in terms of the government's regulating those markets better in the cryptocurrency area, digital asset. But that is referring to that orange line of when the fall of Bitcoin was in the range of 65,000 a share, then it dropped off precipitously, almost 60%. So lost a value of $36,000, $37,000. But that was just the shares of that traded instrument, Bitcoin. 2022 crash we just talked about, Black Monday, is going back to October 1987. 2000 was a dot-com crisis. Financial crisis of 07 was the digital, not the digital, but the mortgage crisis and derivatives. You can see all those crashes were more severe than the one we had last year, is my point of this slide. So if you look at kind of a recap of what's going on in the world, it's still going on with all these bullets, inflation, the war in Europe. We talked about Russia, Ukraine, rising rates. Earnings reports are getting a little more mixed because they're not as ferociously growing in the tech space, certainly, and even a lot of the other S&P 500 companies. Unemployment numbers, interestingly, are low, though, 3.6, 3.7. So just take a kind of a mental picture of this and digest it to this conclusion, which is there have been a lot of other crashes, more severe than what we just went through. And, generally the market does rebound. Keeping on that theme of, what is kind of going on in this economy or what's making all this market shifts occur, the Federal Reserve has an agenda, and the agenda is to slow the economy down so inflation doesn't get ahead of itself. It was pushing, probably in the first quarter 2022 around 8.5%, 9% inflation. It was very significant at that point. So the Federal Reserve kind of went into, let's call it emergency surgery. They raised the rates a lot last year, 3.5% to 4%, short-term interest rates. Historically, again, as I've been keeping on this theme, there's been other times when the Federal Reserve's had to do this. So this is what I'd like you to take away from this slide is, if you looked at 04, 06, just before the mortgage crisis, the Federal Reserve actually went up on short rates almost to the point of 4%. You don't remember it again. It seems like a long time ago, 16 years. But the Federal Reserve has generally been in front of a lot of these crisis arrangements and crisis management. With that discussion, let's kind of keep looking at a little more history and what happened last year with the bond market. But historically, what's gone on last year was terrible, terrible year. Probably by most accounts, one of the worst years in the bond market since recording of bonds began, probably late 1800s. You don't see this a lot, and thankfully, the bond market in 2023 has started out on a real plus side, which I think will continue to evolve. Last year, there was a significant sell-off in long-term bonds and intermediate bonds. What does that mean? A lot of the bond funds you might put money into for retirement accounts, maybe think of treasury bonds and those areas the U.S. government has. Long-term maturities were not popular at all because what was the Federal Reserve doing? They were reducing the short-term interest rate or increasing the short-term interest rate, Therefore, a lot of long-term matured bond money was being sold off and going to the short-term interest rate environment, which was going up. That consequently caused a lot of selling at discounts. when you buy a bond or a bond fund, bond manager tries to buy something and hold it to maturity, be it $1,000 par value. What was happening last year is a lot of things were being sold off before they matured, causing a discount on the portfolio. So last year, probably minus 13, minus 14% real return on bond portfolios, almost unheard of, because you generally buy bonds to manage volatility and protect principal. The good news is, if we look at this year, what's starting to occur in 2023, the bond tide, if you will, is turning to a plus side, and that's a good thing. Reason being, I just mentioned, there's been a lot of sell-off in long-term maturity. The Federal Reserve is reducing a lot of their rate increases. They're reported this year to only be possibly doing 2 rate increases of an average of 0.25. Bond yields started the year at the highest level in years because all of the sell-off in a lot of these portfolios reduced the appreciation of the bonds, but consequently increased the rate of return as an inverse relationship. So take a hard look at bond accounts in your investment allocation. We'll cover that in a minute. But the good news is, for 2023, there's a lot of optimism, positive return on the bond side. So as we keep looking at investment allocation, I want you to just have an idea, because bonds are not everything. You should not put all your dollars, certainly, in bonds, ever, regardless of what stage you're at in your planning, be it 30s, 40s, 50s, 60s, 70s. Bond is part of your mix, but doesn't replace everything you're doing. So real estate investment trusts are a popular one to look at, in terms of investment alternatives and putting in your allocation mix. That, again, tends to be in the area of warehouse, cloud computing space, elder living, assisted living, big rental apartment. Different alternatives. I mean, this could be digital asset, which is down on number 7, but it could also be different forms of commodity. Could be different forms of real estate partnerships. Preferred stocks and dividend stocks tend to be dividend-paying companies. Just think of the ones you all heard about for 50 plus years: AT&T, Verizon, Costco, we talked about, Home Depot. Fixed annuities, I just put on there for you to think about. Not necessarily a proponent of it, but those rates have been going up a lot, and there is a guarantee to it. So if you're the type of person, you're looking for a fixed guarantee and you're nearing more retirement, that's an idea to look at. High yield savings accounts, this would be my one highlight, your current cash savings. If you're dealing with a bank, I would encourage you to look at the 3 different options. Capital One, which you've probably heard of as the credit card company, has a high yield savings, 3.3, and we're going up. No minimum to open the account, just go online and do it. Marcus is sponsored by Goldman Sachs. It's their bank, same kind of yield, and American Express is a high yield account. So if you do anything with kind of your own cash savings, it's just in a bank, you're probably getting absolutely nothing. Look at those 3 alternatives. And then alternative assets, again, I'm not throwing out digital assets. Even after last year's collapse of FTX, it's going to maintain itself and probably grow and be more regulated. Gold and silver. Gold's actually had a pretty good start to the year. It's a little more of a hedge, and I think silver is kind of doing a little better because of its need as a commodity in electrical devices, electrical car, electrical truck. Lithium you hear talked about a lot. So that's the idea on kind of alternatives. So let's keep going on the discussion of, more into the retirement savings a lot of you use, which is 401k. This is sort of a general look at what generally makes up a 401k. 40% of the choices you have in the plan are going to be equity funds, about 30% target funds, the balance 5% non-target bond funds, guaranteed accounts. This is a normal makeup of a 401k plan. Reason I'm bringing this up is when we get to the asset allocation discussion in a minute, just wanted to refresh everybody's memory. You have all these fund choices to pick from in the 401k, or maybe you have another retirement account you're working with. So let's start to look at more of the strategies for 401k and allocation. 401k plans, again, yours is no different. You have mutual funds to pick from conservative to aggressive and in between moderate, etc. You'll see that when you go on the website, they will identify the risk categories of the fund choices you have. Remember, a good time of year to remember this, refresh your memory. What kind of risk do you like to take? How old are you? When are you going to kind of use the money to retire? How much? The reason I'm bringing this up is I think a lot of people got caught off guard, especially last year, where you thought you were in sort of a moderate growth fund, but in fact, you're in a heavy growth fund, which is a fancy way of saying a lot more technology was in that fund. And you may not have thought about that, but I think you got to take a harder look at your account. And if you're more of a moderate type of growth person, now's the time to rebalance. So consider a mix of index and managed. Diversify sounds like common sense, but I think it's important to understand if you have an opportunity within your 401k lineup to pick a large company, a mid company, a small cap, international, maybe a little bond, a little fixed, that's sort of the best allocation as a general statement that you can use. At a minimum, put in, what your employer is matching. Once you've established a portfolio, don't let it just sit. Once a year is a good time of year. This is a great time of year. Rebalance, reposition. So let's kind of start to take a look at that whole allocation idea. This is, again, a general chart, but you should be able to plug in with the list of retirement accounts you have to pick from, whether it's a 401k at work, a retirement IRA, a Roth IRA, wherever you might be putting money away. Let's go in the middle here. Moderate growth seems to appeal to the majority. So that blue part of this pie chart is around 60% or so. What this is saying is 60%, if you're a moderate growth type of risk, 60% should be in that equity area. I mentioned like the large company, the S&P 500, the S&P 600, which is small cap, S&P 400 mid cap, international. And then the 40% is in the bond area, in the fixed kind of stable value area. So that's a very general statement on kind of a moderate growth portfolio, but you should be able to plug in wherever you're, investing for retirement, you should be able to plug in your choices in this type of pie chart from the schedule you have at your 401k, brokerage account, Roth account, wherever you invest. They should tell you what each fund category falls into. Is it growth? Is it bond? Is it a mix? So I'd encourage you, again, if you have, spouse, significant other, show them this kind of chart. I think it's very useful at any age to understand better, how to allocate your money. The last thought I'll leave you with is this. When you do kind of an allocation, again, don't go crazy and look at it every month and rebalance every month, but rebalance at least once a year and make sure that you keep your percentages similar year over year. And what I'm getting at is if you pick 5 different investments for your 401k, your Roth IRA or IRA rollover, 20% in 5 different funds is going to change every year, the holding position, depending on how the fund does, right? Something does really well, the 20% might become 30%. Something does poorly, the 20% might become 10%. So you want to rebalance every year to keep it at 20% in 5 different funds. So give that some thought, when you're rebalancing. Annually is a good time to do it. Now is a great time to do it. So with that, in the final kind of slide, I kind of leave you with this thought, because the theme to any investing is to understand there's going to be bumps along the way, to understand every market is not a bull. Every market is not as strong a bull as we probably went through to the end of 2021. It was about 11 years. Some bulls are stronger than others. So if you look at this graph, this goes all the way back to 1958. But if you just take a couple times, dates in time, 1980, that orange is when the market went down. So for roughly 19 months, the market lost close to 30%. But then it came back up for the next 5 years. That's the blue. Then it fell back down in 1988, only for about 3 or 4 months, and then it went back up that ferocious run from 90 to 2000 or so. So all this is demonstrating to you is just be very careful that when you look at a statement, you go online, you're seeing the headlines in the news, maybe you're around a family gathering and everyone's saying, "Get out of this," things are going to go bad, they're terrible. No one really knows what time to be in, what time to be out of a specific market. It's more important that you're in the market, but the most important part is the last slide we looked at, which is the allocation based on the risk you like to take with your investments. So in concluding, again, we have a little recap here. If any of you are kind of in and out of the discussion, at least I can give you kind of the takeaways. What happened last year? Generally, other than the 3 sectors of of energy, utility, consumer staples. Last year was a tough year. Well, we showed you 2023 has already started off strong. Does not have any guarantees to it, but it certainly indicates that a nice base is being built. Federal Reserve last year did a ton of rate increases, almost 5. Significant because they wanted to really get their arms around runaway inflation. And they did. They've been successful. So this year, the report is they're going to have a lot fewer rate increases and a lot lower amount, maybe 0.25 average. Bond market outlook looks very strong for 2023 because of the massive sell-off last year of intermediate and long-term. So keep that in mind when you're doing your modeling. In investment risk models, we took a look at. Don't be concerned if you do find once you look at your money, if someone's helping you or you're kind of doing an evaluation, that you realize you're in a heavy growth area. Now's the time to rebalance. Don't wait, if you will, for something to come back. You want to really be in the risk model that fits, that fits your criteria. That's the most important item of investing. So I thank all of you for being a great audience in your continued business. We did have one question. The first question is, if you were buying real estate last year and you got delayed, should you stay in that marketplace still or wait? I would suggest if you had a 10-15% down payment and you identified a good property, maybe it's a place you're going to raise your family or you had some investment opportunity. Yes, the rates are higher, but it's still a value proposition, right? Real estate. And if you intend to stay in it a long time, I would still go forward. Just be careful you don't get over leveraged, right? Because the prices may come down a bit and adjust. The second question was regarding stagflation. Do I think stagflation is coming? I do not. That was kind of in the 70s, became an issue, in 73, 74. Stagflation means you had an increased unemployment along with increased inflation. Right now, we have low unemployment and a little higher inflation. I think the Federal Reserve is very sensitive to not making sure that unemployment rate isn't adjusted dramatically to cause that issue of stagflation. So thank you again, and we will all talk soon.